Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And as you would know by now in my regular Wednesday episodes, I talk about the theories, methodologies and principles associated with investing. In these case study episodes, I want to share with you how it works out in real life situations. Before I get into today's episode, I just need to make a correction on the episode that I recorded where I talked about 4 alternative rules-based indexing strategies, alternative to traditional market cap indexing. And I'd just like to thank both Charles and James for pointing out this error. Sort of didn't make myself clear. In fact, I sort of confused myself a little bit and it was just patently wrong what I said. So essentially, when I was explaining the downside to traditional market cap indexing, I used an example where CBA would fall in value, and I said that if it did, it would make up less of the index, and those index funds would have to sell CBA. Of course, that's wrong because as the stock falls, even though it's less of the index, it's less of the index theoretically, and then it's also less of the index in the index fund. The point I was trying to make, which I made very poorly, by the way, and I admit that's an error. The point I was trying to make is that if CBA makes up, say, 10% of the index, which roughly it does, and it falls in value, let's say to 5% of the index, if I go and invest new monies into that index, only 5% of my monies will go into CBA now because it's obviously fallen in value. Now, some would argue that's fine because obviously there's something fundamentally wrong with the stock if it's no longer worth what it used to be worth. And that would be predicated on the assumption that we've got a completely efficient market, which I would argue we don't necessarily have. And if its fundamentals haven't changed, like CBA's fundamentals hasn't changed, why would I be investing less? You know, if CBA's always made up, say, 10% of the index or roughly around that mark, why wouldn't I continue to invest in those proportions, assuming its profitability hasn't changed, its cash flows haven't changed? You know, it's just essentially the same business other than that its share price has fluctuated a little bit. And so that's the point I was trying to make last week, which I made very poorly. And I just wanted to correct that. In fact, if stocks change value in that index, it doesn't mean that index funds need to buy and sell those stocks. There will be some small rebalancing transactions that might need to be made, but they are relatively minor. The major ones are when a stock moves in and out of the index, which I spoke about last week. Anyway, again, thanks, James and Charles, for pointing that error out. I apologise for that miscommunication. Anyway, let's get into today's episode. So today's podcast is about a client that earns a 7-figure income, you know, a substantial income. And so people might be listening to this case study and thinking, well, it doesn't really apply to me. And this comment relates to today's case study, but also future and past case studies as well. Certainly, if you have a higher income, your ability to invest in a variety of different assets changes and your ability to invest different amounts change. But also there's a lot of commonality with respect to strategy and structure, right? So there are, of course, differences between earning $100,000 and $1 million in terms of strategy and what we're investing in. Probably variety of types of assets and asset classes, but many of the concepts are very similar. So if you're listening to a case study like this and you don't have a huge income like this client, just knock off a 0 on the numbers, for example. But the strategy and the reason why I wanted to share this case study isn't because the client had a high income. It's just because there's really been 3 sort of phases with respect to him building wealth, or maybe you'd more correctly call it lifestyle phases. And he's currently spending more money on lifestyle assets, but he wouldn't be able to do that if he hadn't have done the first 2 steps. And that's kind of the theme. That's why I wanted to share today's case study episode. But I just wanted to call out the high income because some people might just tune out and think, well, I've got nothing to learn here. That's actually not the case. Okay, so let's get into into the detail because, we all like the numbers and the detail. So we began working with this client back in 2007. And at that stage, we were providing mortgage advice only. So just doing mortgage broking. The client had a sort of investment property or farm, a home, and a little bit of debt at that particular point in time. So at the end of December 2007, the client's net worth was around about $1.4 million. Then in 2011, the client purchased a family home. He spent $3.8 million on a family home in a fantastic street in a great suburb in Melbourne. And that was the impetus for him to then think, okay, well, I might need some financial advice here because I've now put my roots down. I've got the home that I wanted to have, but also now I've got a higher level of non-tax deductible debt. I know I need to repay that debt, but also I need to build wealth, outside of the family home. And so it's not uncommon for clients to kind of approach us at that point in order to build a long-term strategy so that we can map out, what they need to do, which happened in 2014. So 2007 started dealing with the client. 2011 did the home upgrade. 3 years later, 2014, we drafted a long-term plan for this client. So really from a holistic perspective, we've been working with this client for 10 years now. The first thing we did in 2014 is we bought a house in Richmond, spent about $900 on that. That'd be worth north of 1.3 today. So, growth has not been fantastic. It probably should be closer to being worth 1.7 or 1.8. But, we've written about the Melbourne property market over the last 2 decades, it's underperformed, but I've written about that and spoken about that on this podcast episode. We bought an apartment in Sydney, great suburb of Sydney, for just under $1 million in 2015, so about 9 years ago. That's worth probably 1.5 to 1.6 today, so that's done okay. Again, not fantastic. And then we bought a third investment property in 2016, a 2-bedroom apartment in South Yarra. That's actually done very little in terms of growth. We spent about $660 on that. It's probably worth $750, maybe $800 in today's market. So we bought a property in 14, 15 and 16, and that was really the strategy. Let's call that the kind of gearing phase, if you like, which is, okay, we've got a home, which is great, but we've also got a large amount of non-tax deductible debt. So our strategy response to that was, okay, let's gear up further so that we can create compounding growth. And if we don't, for whatever reason, repay the home loan one day, at least we've got some assets to sell in 10 or 20, 30 years. And that'll crystallize a huge amount of cash that we can then use to potentially reduce debt at that time. So that was kind of how we reacted, at least initially, to that kind of strategy consideration. The other point too here, and I've made it in several episodes really, a bit hard to look at all those 3 assets that were purchased. They're all fantastic assets. They're great quality properties, but the returns aren't reflective of their quality. And we've only owned them for, between 7 to 10 years, which is a reasonable time. And you would hope to enjoy some good growth over that period of time, but not always long enough to enjoy average returns. And again, I've spoken about this previously. So after the investment property acquisition in 2016, we turned our mind to the share market. We started previously, the client wasn't contributing to super, but we certainly started doing that in 2014. But then we thought, we've got the gearing down and we're quite comfortable with the level of exposure there. And I would argue it's been relatively conservative. We weren't too aggressive with the borrowing. We can now invest in other assets like shares, which we decided to do. So in May 2016, we started investing $10,000 a month in a share portfolio. And the goal around that was to try and balance out the gearing, which is going to create very little income with, it's a liquid asset, of course, with building wealth in an asset class that's liquid and provides, more income, but mostly liquid. So it gives us flexibility in the future. So we did that for many years. In 22, we invested in commercial office property through a syndicate. And also in 22, the client bought a beach house, down by the beach, of course. That's where they tend to be located. And also the client is now currently completing a major renovation to his home. So I guess we can look at his strategy, and it's the reason why I wanted to share the case study, is we can look at it in kind of 3 pieces. There was the gearing phase between 14 and 16 where we acquired a bunch of assets. Then we continue to hold and sort of service those assets, maybe put some cash in offset accounts to notionally reduce debt a little bit. But then we sort of switch to, okay, shares and property and assets that are going to generate more balanced level of income and growth. And so that's the second phase, which is really between 16 and 22. And then since 22, the client's then now being focused because he's already built this asset base that's doing really well. The client can then be in a position to start to add some lifestyle assets. So the beach house and renovating the family home. So then let's talk about the numbers. So where is he now? So the 3 investment properties are worth around about 5 mil together with about 2.4 of debt. So he's got about 2.6 million of equity in the property portfolio. There's no equity in the commercial office investments. The share portfolio that we were investing $10,000 a month in May 16 is now worth $1.8 million. So it's funny. I mean, 10 grand's a lot of money each month, of course, but it's funny how these things accumulate. His super is now 865,000 combined with him and his wife. In 2007, it would have been negligible. I don't have numbers in front of me, but it wouldn't have been much. He's got about 2 to 3 million in cash in offset accounts. Some of this is going to be used for the home renovations, of course. So his net worth, including his homes, north of $15 million. It's going to depend on what the home's worth once the renovations are complete, of course. So he's gone from 1.4 in end of 07 to $15 million today, noting that, of course, the income contribution, the amount of income this client has earned over that period of time has been substantial. It's been very substantial over the last 7 years, but the previous years to that, it was strong, but not extraordinary. I would probably describe it that way. So as you know, I like to sort of wrap it up and think, okay, given that client situation, what can we learn about it? Well, I think he engaged the advice process at exactly the right time. He obviously had the goal in his mind that, okay, we're going to upgrade the home. That's kind of a priority. But once we do that, and that's going to give rise to a lot of non-tax deductible debt, then I need to have a plan on A, how I'm going to deal with this non-tax deductible debt, and B, what I'm going to do with future cash flow in order to build wealth. So I think that's a good juncture to sort of reach out and do that. I mean, you wouldn't necessarily need that advice before you did the home upgrade. I mean, doing the home upgrade well in terms of buying the right location property is important too. Sometimes I find clients will reach out just when they're starting to think about having children. If they're a relatively young couple, been working, then when they start contemplating building a family, they start to forces them to think more about the future. It's a difficult time to sometimes map out a plan because there's a lot that can change. And the next juncture, which, I mean, it's never too late to start the journey, but maybe is arguably not a perfect time, is typically when kids are older. And so clients can see past the private school fees. They're going to end in 1 or 2 years' time. They realize then they're going to have a much larger surplus cash flow, and they acknowledge we should have done something years ago. And typically that's when they reach out. But I thought that was a really good time to typically put a long-term plan together. The second point is gearing early on in the strategy has kind of laid the groundwork for future compounding growth. So I acknowledge the properties haven't achieved the average returns that we would hope that they would have by now, but that's not to say we're not confident. I'm supremely confident. They're all fantastic assets. In another 10 years' time, so after owning these assets for almost 20 years, when I record this case study episode, I hope I'm still jabbering on in 10 years' time. We've got a high level of confidence that we'll be turning around and going, look, these are great assets. But he's laid the groundwork and he's got some equity in that portfolio as well. So that's allowed him then to know, well, if I do allocate more resources to lifestyle assets, these things are ticking along in the background. And to do that early on in the strategy, that was very important. The share investing was important too. It provides a bit of diversification in his strategy and also a bit of flexibility. If he decides he doesn't want to work as hard in the future, he's got some liquid assets to help sort of supplement any reduction in income at that time. But also it was used as a means of controlling cash flow as well. So monitoring your spending is important at almost every income level. Look, I'm sure if you're a multi-billionaire, you probably don't need to worry about it. But even someone earning, say, $5 million of income versus $50,000 of income, it's still important to manage cash flow because it can still get out of control and you can still end up spending and wasting money on things that you don't need. So sometimes the best reaction to that is invest first and then spend what's left over if you don't have other means of controlling it. And so carving off the $10,000 a month at that particular time, we increased it only a few months ago, but in terms of the investment amount, but carving carving off that $10,000 a month was a kind of way of forced savings, if you like. And it's amazing I've written a blog about consistency of effort with respect to building wealth. It's amazing that if you doesn't really matter what it is, if it's $500 a month, $5,000 a month, or $50,000 a month, it's the consistency of just investing it every single month for many years. Believe it or not, you'll wake up one day and the portfolio will be much larger than you ever imagined. And so this client's been doing it since 2016, which is 8 years? 8 years, it's gone from sort of 0 to 1.8, which is, an outstanding result, I think, for this client. But it just shows there's no magic here. It just shows that it's really the consistency of effort that is so important. And all the things that we did between 2014 and 2022 has put him in a position, as I said, to now focus on lifestyle assets. He's got enough wealth. He doesn't actually need to, he will, but he doesn't really need to invest another dollar. He's got enough sort of growth assets now. They'll do their thing. He'll have more than enough money than he'll ever need. But it's because of all the hard work and the prioritization of building wealth between 14 and 22 that he's in this position now where he can invest in these lifestyle assets. So hopefully you can see why I thought it was a good case study to share. If you do have any questions, feel free to send them to me at questions@investopoly.com.au. Be careful, try and make them sort of general questions. I can't give you specific personal advice on this podcast, of course, but what I'm hoping to do is if you have a general question about a particular asset class or way of investing or something that I've spoken about, it's likely that other people are going to have the same question, and to create that sort of interaction, that's what I'm kind of keen to do. So if you have those sort of general questions, please send them to me at questions@investopoly.com.au. The link to that email address is in the show notes. And until tomorrow, bye for now.